This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, as promised at the end of last session, we now turn our attention to probably the most important, in terms of examination significance anyway, benefit that we may have to deal with. Now, in the vast majority of occasions, the provision of a company car by an employer is going to give rise to a taxable benefit. But as we saw with living accommodation, there will be one exception to this, where it's possible indeed to have an exempt benefit. And that's where, just creeping in at the bottom of the page that you can see on your screens now, we see this one, that if we have electric cars with zero CO2 emissions, then a 0% assessable benefit applies. It is exempt, therefore. What we see here is that, and with the system that we now have from 2021, we've always had a system that would charge rather more in terms of a taxable benefit in relation to, shall we call them, dirty cars, those with high CO2 emissions. So the higher the CO2 emission, then the greater would be the taxable benefit. The lower the CO2 emission, then the smaller would be that benefit. Well, that has now become even more important in the context of, from 2021 anyway, the fundamental changes that have occurred. And it's accepting, of course, from now onwards, indeed, we've got rather more in the way of electric and hybrid cars. And because of that, the HMRC have changed fundamentally the basis by which we determine an assessment for a tax year. So although, yes, in reality, if you have the totally clean car with, indeed, a clean machine, we may call it there, a 0% CO2 emissions electric car, obviously, then there's going to be no taxable benefit at all. We're going to see something in an exam question, which, of course, is not going to have 0%. There's going to be some sort of percentage. And what we've then got to do is to look at the various criteria that we use in relation to determining an assessable benefit. And as we'll see here, that any calculation that you have to perform, and you will should it be a Section A question, then these are the issues that we need to look at in terms of identifying the method by which we will compute the assessable benefit. As we've just seen, if it is electric with zero CO2 emissions, then it is an exempt benefit. There's a 0% assessable benefit. Then what happens if it's hybrid powered? So we've got some fossil fuel, be it petrol or diesel, but we've also got electric in there as well. Well, there, again, we'll be looking at CO2 emissions as a basis for initially determining the amount of benefit. But we'll also be looking at what they refer to as the electric range. How far can this machine run on its batteries there? We then get to, well, what we've had forever and a day, the historic petrol-powered and diesel-powered cars. And as we'll discover with those, that's where, of course, we're going to see the highest amount of taxable benefit. There is a cap that we'll see that will apply in terms of what the maximum taxable benefit could be. But if we're talking about petrol, or often and even more so with diesel-powered cars, that's where the higher or the highest taxable benefits indeed may be found. Now, as we've just said, if we just go back to that first paragraph, the more widespread use of electric and hybrid cars has brought about now from 2021 this fundamental change in the computation of any assessable benefit for the use of a company car. Now, there, as we've said, is from 2021. And thankfully here, for our purposes, rather than, because in 2021, it won't just be the new rules that apply to the new, we've had old cars as well. And there's a transition situation. We don't have to know any of that. So thankfully, our examiner will now only include the treatment of cars that were registered from the 6th of April 2020, the very first day of our tax year. So you're going to see a number of questions where the provision of this car was exactly from that date, the 6th of April, and it will have extended for the whole year. Because again, we're into this important issue that many of the benefits that we compute, for example, living accommodation, assets made available for private use of an employee, that in these situations, we're going to have a situation where if you haven't had that particular benefit for the entire tax year, given that what we compute is an annual benefit, there will be a need to time apportion. So the first thing you're going to have to look at here in such a question, in terms, thinking mostly in terms of a Section 8, but it could be a Section C question, you're going to have to look at what date was it provided from. And many of these dates will be from the 6th of April 2020. And undoubtedly, it will then have been provided throughout the entirety of the 2021 tax year. But if we get a situation where it's other than the 6th of April 20, it is a later date, but at some point within the course of the 2021 tax year, then there's going to have to be a time apportionment exercise. If we're only provided with this company car from, say, the 1st of January 2021, then we've only got it for the last 3 months of the tax year. And once again, our apportionments will be to the nearest month. So look at, therefore, for the date at which that company car is provided. It's going to be one of two things. Either the 6th of April 2020, it cannot be earlier than that, or it will be later in the tax year. So if it's other than 6th of April, we're going to have to do a time apportionment of what would be otherwise our computed annual benefit. Okay, so it's only those cars that onwards which the new rules apply, and it is only these new rules that we need to know. Again, as we've already said, it's not likely in a Section A question because it would be too quick and too easy, that we're looking at an electric car with zero CO2 emissions, which just means there's zero assessable benefit. What is very likely is we'll see something that is hybrid powered, because that has brought in a new issue, which again, a fundamental change here we hadn't seen before, which was based on the electric range. Now, those electric ranges will go through different levels of mileage there. And don't worry, all those different levels, that information is provided to us on our rates and allowances page. Now, you can find that rates and allowances, of course, at the front of our study notes, or if you just go through to the next page, you will see also the information that is provided to you in the exam. So this information, you do not have to learn, you certainly do have to learn how to apply this information. So you will see there, electric range. It would be stupidity to try to get you to learn such figures. There is then various other information that is provided here. What we'll see, and keep that open, or if you've got your rates and allowances page separately for the car benefits, keep that to one side. So as we go through, you'll be able to see, right, okay, that is given to me, this isn't, and therefore that is what will need to be learned. So it's a combination of information provided on your fact sheet, your rates and allowances page, but also stuff that needs to be learned. So let's go back, therefore. We've introduced the different categories that we're going to have to look at, and I've also mentioned about CO2 emissions. In this paragraph here, we talk about what are the issues that you need to look for. We've already said, before any of this comes in, look at that date at which the car was provided. Was it the 6th of April, giving rise, therefore, to a full 2021 tax year annual benefit, or was it a date later than that, in which case, having computed the annual benefit, you would then time apportion? What else? It's necessary to know the level of CO2 emissions. Again, it is a critical issue. The level of CO2 emissions will determine the amount of assessable benefit that will arise. The higher the CO2 emissions, then the bigger will be the taxable amount of benefit. And if it's applicable, the electric range. And that is applicable when dealing with a hybrid car. We'll also need to know the list price of the car. Now note, list price, not the cost of the car, but the original list price of that car. Again, an exam question, it is likely that whenever that car is provided to you, be it the 6th of April 2020, or be it a date later in the tax year, that they tell you two figures, both the price paid, the cost of that car, and the list price. It is the list price, certain to be a higher figure than the actual cost. It is the list price that is going to go into our calculations, where appropriate, of assessable benefit. Based then on the amount of CO2 emissions, we will be able to apply a given set percentage to then that list price to get the basic working of the taxable benefit. Based, as I've said, on the CO2 emissions, you will read off from a table provided, well, not read off from a table provided, but use the information provided. Also, you will use what you've had to learn to determine a percentage that will then be applied to the list price. So the CO2 emissions will give us a percentage figure to apply to the list price. Now, that percentage figure will be applied to the list price, as we said, based on the CO2 emissions, essentially. Applied to the list price to compute the annual benefit for the tax year and factor the numbers to be used to provided to you on the tax rates and allowances page provided in the exam, as we've seen shown below. All you have to do is to know how to use this information. Yeah, there's certain little bits extra stuff that we do have to learn here for when those CO2 emissions exceed what is called a base level. But most of the information we need is provided to you. Right. We said electric cars with CO2 emissions are exempt. We then got these hybrid cars. Again, they've been around for a long time, but we've now seen a bigger uptake in relation to that. They become more important. So HMRC decided right from 2021, we're going to change the system to accommodate the fact that a lot of employees are now driving around in these hybrid cars. That is only going to increase, as will be the provision of fully electric cars. Right, for hybrid, with CO2 emissions between 1 and 50 grams per kilometre, the electric range will determine what percentage rate to apply to the list price. Remember, the basic calculation is we would be looking at a percentage to apply to the list price. We will need that percentage to apply to a list price. Again, that percentage based on CO2 emissions. These percentage rates for the electric range are provided in the exam. Again, see below. So that information is provided to us. And what we can see here is that the bigger the electric range, so the less the need for fuel, in terms of fossil fuel there, your petrol or diesel, the bigger the electric range, the lower will be the assessable benefit. So if it's 130 miles or more, 0%, again, effectively, this will be exempt. If we have less than 30 miles, so the battery's like a couple of AA batteries that you stick in a torch or something there, then it's going to be quite high. It's going to be 12%. In between, you've got those provisions. As we've seen, you don't have to learn. You simply have to look it up on your rates and allowances page in the exam. If we go above there, the CO2 emissions level of 50 grams, for any car with the CO2 emissions that exceed, and this is any car that we're talking in terms of now, be it hybrid, be it just petrol or the diesel car. The percentage rate to apply to the list price is as follows, again provided for you in the exam. So there's a couple of figures. From 51 to 54 grams, we have got 13%, and from 55 grams, for exactly 55 grams per kilometre, it is 14%. And that's our sort of base percentage that we'll be talking in terms of. Now, as you can well imagine, there are still out there an awful lot of cars, or a lot of awful cars, some of you may say, that have hugely higher CO2 emissions than that. Basically, anything that's worth driving. So In which case, what happens if we go above the 55 grams per kilometre? Now, this is a bit that you're going to have to learn, because certainly historically, and I think other than testing this new bit of the electric range issue, we're still going to see exam questions in section A, let alone section C, that will involve a CO2 emission that's in excess of 55 grams per kilometre. So what happens when we go above? Right, what you have to learn. For cars with CO2 emissions in excess of 55 grams, the base percentage rate of 14%, there's your base percentage rate, based on 55 grams per kilometre, will increase. It'll increase by 1% for every complete 5 grams per kilometre, up to a maximum percentage rate of 37%. What do we mean by that? Well, let's say that we have CO2 emissions here equal to 134 grams per kilometre. Right, clearly 134, that exceeds 55 grams. So what we know is that in working out what that percentage rate will be, we'll start with 14%. It will then be plus. Plus what, do I hear you say? Now then, it says we're going to go up by 1% for every complete 5 grams per kilometre, up to that maximum percentage rate of 37%. So what that means is, whatever grams per kilometre you're given, here 134, we round down to the nearest multiple. We round down to the nearest multiple of 5. So that would be 130. And we look by how much does that exceed 55. And then that figure we divide by 5, because it goes up by 1% for every complete 5 grams per kilometre. So, what have we got there for? 130 minus 55, in which case, get your calculator out and do that. And what's that? 45 plus 30, so that's 75. 75 divide by 5, work that one through, and I think that therefore is going to be 15. So what we have is an increase of 15% over and above the base figure of 14%. So look at what we've done. We have CO2 emissions in excess of 55 grams per kilometre. So we start at 14%, the figure for 55, and then for every complete 5 grams per kilometre in excess of 55, we add 1%. So with 134, round down to the nearest multiple of 5, that will be 130. See by how much does that exceed the base level of 55. In this example, if my mental arithmetic is right anyway, that is 75, divide by 5, and you've got yourself 15% there. 15%. Right, let's just check. 14% plus 15% equals 29%. Does that exceed the maximum of 37? No, it doesn't. So 29% will be the figure to use. To use against what? What do we apply that to establish this annual benefit? We apply it here to the list price. Now, the situation you'll find in your exam, as we're only dealing with cars that have been supplied to the employee here from the 6th of April 2020 onwards. So we're going to be told, therefore, for example, say on the 6th of April 20, this car was purchased. They may give you the purchase cost, but that doesn't matter. And here is the list price. The list price here is, say, £20,000. We therefore apply 29% to that £20,000. 20,000, 29%, 2 times 2,900 is what, 5,000? 5,800, but check that, 5,800. Now that will be the annual benefit. So if this car was provided to this employee from the 6th of April 2020 and it's through the entire tax year, still has the use of the car by the end of the tax year or at the end of the tax year, then 5,800 with the assessable benefit. So you now have a financial figure to include within the employment income assessment. You would have whatever was the salary of the individual, whatever commission or bonus was received by the individual there. We've got all of that cash remuneration. We've got any other benefits that we've already spoken of. And we've got, in terms of the provision of the car benefit, as computed here, 20,000 at 29% is 5,800. If that car was only provided halfway through the tax year, then only half of that 5,800, i.e. 2,900, therefore, would be the assessable benefit. Again, check that date out very carefully. Right. Now, those percentage rates, up to the maximum of 37%, as we've said, apply to both petrol-powered cars and also diesel cars, but those that meet, it's called the Real Driving Emissions 2 standard, and it will be given to you in that form in terms of your exam, the RDE2 standard. For diesel cars that do not meet, you will be told whether a diesel car does or does not meet the RDE2 standard. But if it does not meet that standard, then on top of what we have just computed, we just computed 29% in this example, the percentage rate is increased by 4%, but will not exceed 37. So if this car that we're dealing with in our made-up example now was a diesel-powered car, if it met the RDE2 standard, you will be told that it's 29% of the calculation we do as we would for a petrol-powered car. If you are told in the question that it is diesel, but it does not meet the RDE2 standard, then you've got to add this 4%. So we had 29% plus 4% equals 33%. Again, though, be careful, must not exceed 37. That is a cap, whatever car we're dealing with. It's not going to exceed 37. Well, it doesn't. That is 33% here. If this figure had been something like 35% or more, then plus 4% would take you above 37 there. Again, it could be slightly lower than that, but if it goes above 37, you cap at 37. That's the most that it can be. As we've said, that percentage rate is then applied to the list price of the vehicle, a figure that is likely to simply be given to you. If they want to elaborate on this in terms of your exam question, then we need to know that the list price includes the list price of any accessories fitted to the car. Again, there may be, whenever you bought a new car, or when maybe that is a day we aspire to, there's all those added extras that goes tick, 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 and up goes the price hugely there. Well, if you have those added extras going in, then you add those into the list price. It is that complete total figure that you then apply your percentage rate to. The list price, however, is reduced by any capital contribution from the employee, subject to a maximum deduction of £5,000. Now I think, well, what's going on here? Capital contribution made by the employee. Yeah, it's maybe more common than you might think. Possibly in terms of the particular employer for whom this employee works, they have a cap that says you at your level, your grade in terms of your employee status, you are entitled to select any car, maybe from these particular cars, but otherwise any car, but up to a cost to us, the company, of £25,000. And the one that you really want costs £27,000. So what you do is to say to the to the employer there, you say, look, I tell you what, I know the cap is 25, we'll stick to that, but I'll put the extra 2,000 because that's the car that I really, really want to be driving around in. And again, if the employer is happy with that, then so be it, you can do it. So you've made a capital contribution towards the cost of the car. But remember, it is not then the cost of that car, the 27,000 that I gave you a moment ago. It is not that goes into the computation of the assessable benefit. It is instead the list price. So the exam question would tell you list price is, say, £30,000. And therefore, you've made a capital contribution of 2,000. So the list price to go into your computation of assessable benefit, that list price was 30,000, but it is reduced by the capital contribution that you have made. 2,000 away from it would be 28,000. And that is the figure to which you would then apply your percentage rate. So that list price reduced by any capital contribution of the employee, but to a maximum deduction of 5,000. So if the employee was mad enough to say contribute £6,000 towards the original capital cost of the car, you'd only get a deduction of 5,000. So we cap that at 5,000. So just a couple of little bits that may interact in terms of getting the correct list price to which you apply your percentage rate. Those are the two most tested issues. We have said already, of course, that the car benefit is an annual benefit. So we're already aware to look out for, was it the 6th of April at the start of the tax year when that particular car was provided to us, or did it come later in the year and therefore we need to time apportion? That car benefit will also be proportionately reduced if a motor car is unavailable for periods of at least 30 days of the tax year. So if you're without that car for whatever reason, it's not available for your use for at least 30 days, then we time apportion. Again, it is something that is less likely to be tested in all honesty. And again, when we do it, we'll go to the nearest month in terms of our calculations. What you are very likely to see as a reduction in the taxable benefit is where the employee makes a contribution to the employer for the use of the car. It may be said in a question that the employer requires the employee to make a contribution of £100 per month because, of course, the employee has the private use of that car as well as merely the business use. So where that happens, £100 a month, that is an allowable deduction against the assessable benefit. So that is a reduction, therefore, in the assessable benefit. The car benefit itself is proportionately reduced. So if up here we had computed, what did we say when it was 29%? We said, what was it, £5,800? If we had that assessable benefit of 5,008, but we'd had the car for the whole year, remember that was the annual benefit, 20,000 at 29% there, 5,800, but the employee had paid £100 a month for the benefit of the private use of the car, that is to the employer. That's £1,200 for the full year, and on that basis, therefore, we take the 1,200 away from 5,800. If, as we said, we'd only had the car for half of the tax year, then we'd only be talking, of course, of half an annual benefit, and we'd only have 6 months' worth of payments of £100. So we'd be deducting 600 from what would be otherwise 6/12 of the annual benefit. Returning to our notes, again, we don't think it's likely that an employer would provide an employee with the use of a second motor car. Here's one for the week and here's one for the weekend. I don't think many of us have employers like that. But if there was a provision of a second car where more than one motor car is made available to an employee, the benefit of each motor car is computed as above. So however many you've got, you just use exactly the same basis of calculation to determine what will be the annual benefit to charge upon the employee. Very occasionally, and probably more likely in a Section C written question, we get provided with the use of what's called a pool car. What do we mean by that? Well, firstly, the use of a pool car does not result in a company car benefit, and a pool car is one provided for the use of any employee. So this is not a car made available for the private use of any individual employee. It's provided for the use of any employee for business purposes, so it is not for private use. It will only be used for business purposes, and it is kept at the business place of work. So there's no individual taking this home every night and using it as basically his car or her car to commute to and from work. This is kept at the place of work. There's the keys in the office, and anybody needs to go out on business, visit a client or go to a supplier or whatever, there's the keys, off you go, you can use that pool car. That's a pool car, and the fact that an employee has the use of such a pool car is not a problem. There is no assessable benefit. Again, take a moment there to have a look through that information that is provided to you, and once you've gone back through what I've said, then come back to me, because what we'll then do is to have a little go at example 4. But pause for the moment while you go back and check on the things that I've just talked you through. Then we'll have a proper go at example 4. Okay, let's have a look at example 4. Now, we're going to go slightly out of order here, and I'll take you through this first one, Nico. Let's pick on that one. We'll come back to Lewis. God bless him. We'll come back to Lewis in a moment's time, but Nico was provided with, now, the information you need to know. This is a petrol-powered car here throughout the 2020-21, i.e. it was supplied to here, Nico, on the 6th of April 2020. Anything before that date is outside the scope of our syllabus. So we know it's petrol. We know we've had it from the 6th of April 2020 onwards. The list price is $16,400. And of course, the other critical information is the official CO2 emission rate, and that's 162 grams per kilometre. Right. So we needed to know when was the car made available. This was from the 6th of April. It's throughout the tax year. So from the 6th of April 2020, so we get a full annual benefit. What other information do we then need? We need the list price, to which a percentage rate will then be applied. Now we've noticed here that this is a petrol-powered car, so we don't have the issue of being diesel-powered. Does it or does it not meet the RDE2 standard? Will there or will there not be a plus 4%? Irrelevant, because this is petrol-powered, not diesel. What we do need to know is the CO2 emissions, and that's 162 grams. What does that mean? It means it exceeds 55%. At 55%, the percentage rate would be 14%. A figure again provided to you on your rates and allowances pages. Again, though, I think by the time you walk into the exam room, a figure you'll be more than familiar with. What you do have to learn and then know how to apply is what happens when, as here, those CO2 emissions have exceeded 55 grams per kilometre. We know that we will increase that 14% base percentage rate by 1% for every complete 5 grams per kilometre in excess of the 55 gram limit. Every complete 5 grams per kilometre. So what do? We round down to the nearest multiple of 5. So 162 rounds down to 160. Minus 55 and divide that by 5 and add it to 14%. Well, 160 minus 55 is what? 105. 105 divided by 5, well, 100 divided by 5 would be 20, so that's 21. But again, play it safe, use your calculator. 160 minus 55 is 105, divide by 5, that equals 21%. 14% plus 21% equals 35%. Is it diesel powered not meeting the RDE2 standard? No, so no plus 4%. Does this figure exceed 37%? No, it doesn't. So yes, that is the figure to use. What do we do with it? You apply that 35% to the £16,400 figure. Whatever that comes out to, that is the full annual assessable benefit. If it wasn't the case here, but if we'd only been provided with that car from halfway through the tax year, that would either be the 1st, they might even say the 6th of October there, but halfway through the tax year, then we'd only take 6/12 of that annual benefit and assess for the 2021 tax year. Now you can look at the answer to that in the back in a moment, but only after you've had a go firstly at this one, Lewis, where again, what information do we have? This one is a new diesel-powered car, but look at the date of provision, the 6th of August 2020. So you're going to have to do a monthly time apportionment of the annual benefit that you compute. List price, 13,500. CO2 emission rate, 122 grams per kilometre. And the car meets the RDE2 standard, i.e. there's no add-on of 4% in relation to this assessable benefit. So again, we have the situation where, as ever, you'll be told what the list price is. You've got to work out the percentage rate based on 122 grams. Again, that exceeds, as we know, the base rate of 55 grams per kilometre. Round it down to the nearest multiple of 5. What's the excess over 55? For each such 5 grams there, so divide by 5, we have a 1% increase. And apply that, add that figure through to your benchmark 14%. If, of course, that were to exceed, it won't, but if, of course, it were to exceed 37, you would cap at 37%. Remember again, provision on the 6th of August 20, so the annual benefit must be time apportioned. You can check that one out. You can also, of course, check out and agree the answer to Nico we've already done. And then you will have a go at Fernando. I won't want you to do anything other than Lewis and Fernando here, but it's petrol powered for Fernando throughout 2021. So again, it will be written, was provided on the 6th of April 2020. List price, 22,600. CO2 emissions, 249 grams per kilometre. That's a very big number. So I wonder what issue that is going to bring into play as regards what you will use as your percentage rate. Also, Fernando paid the employer here £1,200 during 2021 for the use of the car. So we are able to deduct, therefore, the £1,200. This car has been provided for the entire year, and that means in computing the taxable benefit, we're able to deduct £1,200 away from whatever you compute as your relevant percentage rate times the list price. Nearly gave it away. You will establish what that figure is and take away that £1,200 employee contribution to the employer for having the benefit of the private use of that car. So check out those first 3, only once you've had a go yourself. No auditing the answers here as ever. You do it for yourself, check it out. Okay, we'll have a quick run through those after this pause. Also, before you come back, we're going to move on to a new hybrid electric powered company car there. So do have a look at what happens with the hybrid cars. You are, of course, going to be using some of the further information provided on your fact sheet. Over to you. Okay, let's see how we've got on therefore with those little examples, starting with Lewis here. So again, we want to know about the CO2 emissions. They are above 55 grams per kilometre. So we're going to start with our benchmark base rate of 14%, and we're going to add to it. We're going to add to it 1% for every complete 5 grams per kilometre above that 55 grams per kilometre figure provided to us. So we round down to the nearest multiple of 5, so that's 120, minus 55, that is an excess of 65, divide by 5, equals 13% there, therefore. So we add 13% to the base rate of 14, and that therefore will give us 27% as stated there. The 4% surcharge, remember it was a diesel car, is not applied because it did meet the RDE2 standard. What of course you had to do here, which we didn't have to do with NECO, was to then time apportion because the benefit had not been provided throughout the tax year. The car was not provided on the 6th of April 2020. It was the 6th of August 2020. So we must do a time apportioned benefit. But again, the basic benefit itself to begin with. What was the list price? 13,500. What is the percentage we've just computed? 27%. That would be the annual benefit. We've only had the benefit from the 6th of August 2020 through to the end of the tax year. That, I hope, is 8 months. And if my use of a calculator is correct, that will mean that 27% of £13,500 multiplied by 8/12 comes out to £2,430, and that will be the 2021 taxable benefit to again include within the employment income assessment for young Lewis here. The issue with Fernando was, of course, that the CO2 emissions of the car provided were huge. And that would mean, therefore, even without doing any detailed calculations, we knew that we were going to exceed 37%, and therefore we would use 37% as the maximum figure and apply to our relevant list price of the car. So the CO2 emissions are above the base level figure of 55. When we do the calculations, not that you would bother here, in all honesty, the relevant percentage was 52, based on round down to the nearest multiple of 5, 245, minus 55, 190 divided by 5, well that's 38 in its own right. Add it to 14 would be 52, clearly in excess of 37, so you limit to the maximum 37%. Remember, that is a figure that you have to learn for yourself. You have to memorise that one. That is not a figure provided to you by the examiner. Motorcar again was available throughout 2021, so we got a benefit of 7,162. But how did we get that? Oh, tickle in the nose. All is well. So we've got to take away the £1,200 employee contribution to the employer for the benefit of the car. Watch out with these contributions to the employer. Distinguish between what was a capital contribution towards the cost of providing the car, which is deducted from the list price to a maximum of £5,000, to what this is, which is a year-on-year requirement for the employee to make a contribution to the employer for the benefit of having the private use of that car. That is an annual deduction that you do based on the amount of contributions made to the employer. That is very different to the £5,000 maximum capital contribution, where with a capital contribution, you reduce the list price that then goes into the calculation of the assessable benefit. So distinguish between the capital contribution and what effectively here is a revenue contribution, paying back to the employer a little something for the benefit of the private use of that car. Okay, back therefore now, hopefully all is well with those first three, and we look at Jensen. Now then, what's Jensen got that the others haven't? He's got a new hybrid electric powered company car. Again, throughout 2021, the question would say was provided with it on the 6th of April 2020. The car had a list price of $16,000, we need that of course, and had an official CO2 emission rate of 38 grams per kilometre. Now that 38 is less than 50, and therefore we become interested in the electric range. And that electric range is 110 miles, because that information is now going to provide to us the relevant percentage to apply to the list price. If we go back to the information that is provided to us, read the electric range provided to us in the exam, you pick from there where your level of electric range fits, and we had was 110, so very clearly therefore that's between 70 and 129 miles, and that gives us a 3% figure. So in which case, looking at the answer, the CO2 emissions do not exceed 50 grams per kilometre, so we're interested in the electric range of the car. This is between 70 and 129 miles. Reading that off from the table provided to you, not a learning exercise, the percentage rate is 3%. The benefit therefore, as ever, list price times your percentage rate. That will be your annual benefit for the 2021 tax year. And as Jensen had that car for the entirety of the tax year, it'll be the full £480 figure. But you can see, as soon as we get into hybrid electric, we are talking about much, much lower taxable benefits. Again, one way by which the government can influence behaviour of the taxpayer by the taxation system, encouraging to do something good rather than something bad. Let's therefore try to clean up the planet rather than make it an even bigger mess than we already have of it there. Again, taxation is there, of course, fundamentally to raise money for government public expenditure, but it also can be used as this tool of encouraging us to do things that are better for the community and now indeed, and most importantly, better for the planet as well. That sorts out Jensen. Back to our information in the question. There's one other for you to have a go at. Provided with a new diesel car throughout 2021, again from 6th of April 20, list price 14,000, official CO2 emission rate 103 grams per kilometre, does not meet the RDE2 standard. That's the only new thing that comes into this particular exercise. Have a go at that. Hope you understand what that means. Again, that is something you have to learn what happens where it's diesel not meeting the RDE2 standard, and put that through your calculation of the assessable benefit. Check that out, please, along with everything else we've done on cars in this particular session. And again, from whichever exam kit that you have available to you, you can have a go at any such examples that are just dealing with the provision of the car. If the question includes the provision of the fuel and you've got to compute a fuel benefit, leave that alone. We haven't done it yet. But don't worry, that is indeed what we'll be kicking off our next lecture together with: fuel provided for that private use.